All right, let's talk about saving you some money this morning. Not going to bum you out about the tax man. We're going to hopefully make you happy that we found some deductions for you here this morning. Joining me is Christopher Dukes, who is a wealth manager, but they also do some tax work as well. Christopher, good morning.
Thank you for having me. Appreciate it.
So I'm reading the list here, and you know, some of these people probably forgot about. Let's just start at the top. You have the 7 here.
These are the 7, you know, and if you haven't done your taxes yet, you've got till Tuesday. You got to have it postmarked. We just got a couple of days left, and these are ones that we see a lot of clients forget. So we want to make sure that if you haven't done your taxes yet, you know these are available to you.
You got it. All right, let's start with the little tiny lettering, but charitable deductions.
Yes, charitable
You know,
deductions.
people sometimes forget, hey, I gave money to this, I gave money to that.
Absolutely. So if you gave time or money to a charity last year, both of those things can be deducted. Now, if it's money, it's $250 or more, you'd have to prove with some type of documentation from that charity, right? Correct, some type of receipt. Now, if it's time, all of your expenses within that time can be deductible as well. So your meals, your travel, in fact, up to 14 cents per mile can be deducted while you were doing work for that particular charity.
Well, that's great.
It is. It's a great thing, and it's, you know, if you give your time to people, I think you should be rewarded for that, whether it's time or money, and these charities are certainly deserving of that.
You got it. All right, the next one on the list would be the tuition. Now, this is, I didn't know that you could actually write off your tuition and some of the other expenses around getting an education.
Exactly. Listen, if you're looking to further your education, things like tuition and fees can be deductible for you. To be official, up to $4,000 for the year. Tuition and fees, books, and that type of thing can be deductible for you, a spouse, or a dependent, depending upon what you are doing. Technically, this is the American Opportunity Tax Credit. It's for college expenses, and credits are better than deductions because credits are dollar for dollar. A deduction is only based on what your tax bracket is.
Right.
So, credit's going to be a very, very good deal for you. And if you've been looking to further your education, this is something that benefits you while you're doing that.
I love it. Almost an incentive to go out and get a better education.
Exactly. Even if you're just
write it off.
Right. If you're just taking one class, you can still do it.
Right. All right. Not a lot of people keep the receipts for state and local sales taxes, but you can actually write off those things if you keep all your receipts.
That's exactly right. Now, you know, people say all the time, well, they know that they live in a state that has state income tax. Of course, you can write that off. But what if I live in a state that doesn't have a state income tax? What type of benefit is there for me? Well, if you live in one of those states, like Nevada, for example, you can actually write off sales tax. So say you made a big purchase last year, you rewarded yourself and bought a boat or a car or something like that. That sales tax, that large portion of that sales tax is now deductible for you.
Wonderful.
Yeah, makes it a great benefit, especially if you live in a state that you can't deduct the state income tax because there isn't one.
You got it. All right, so the Earned Income Credit, what is that?
Yes, this is known as the EIC, and this is for folks that have low to moderate income. So technically, this credit can be worth up to $6,044 for you. Now, what this we see a lot of people overlook this because they're lower income and say, well, I don't think I'll qualify for this, okay? Now, technically, the IRS says if you make $10,000 or more, you need to qualify. But or you need to file. Even if you didn't make $10,000 though, I still tell clients, some of the lower income clients, listen, go on TurboTax. If you're doing this yourself, look for the tab. It's very easy to see. Do I qualify? You click on the tab. There's 3 or 4 questions there. And if you do qualify, it's automatically given to you up to the $6,044, which obviously is going to help you in a year where you didn't make that much money.
Right, exactly, for that particular income bracket. And job searching, you can write that off.
Correct. We were just talking about this before we came on. So, you know, say last year you were searching for a job, you were in between jobs, you know, did you have expenses like a job placement agency? Did you print a bunch of resumes? You know, when you were out looking for that job, did you go have a burger or did you, put some gas in the car? All of those things now could be deductible for you while you were searching for the job. Now, remember, this is a tough one, so you need to keep the who, what, when, where, and why.
You need receipts.
Absolutely. Be sure you have those in case of the old dreaded audit. That way you can prove it.
So in other words, let's say, you know, a while back I was living in Phoenix and I had to drive back and forth to San Diego to look for a job. I could write that off.
Absolutely. Yep. You've got a portion of that, plus you had to eat during that time.
Man, I wish I would have kept those receipts. Actually, I did keep a couple of them. I did keep a few. Retirement.
Yes. So this one is a credit.
Saving.
Yes. This is a retirement savers credit. Now, this one is specific. So, if you're out there today, you need to listen to this one. If you have an income and you're single, up to $29,500 or $59,000 if you're married filing jointly. You can get a credit up to $1,000 for single or up to $2,000 for a couple if you gave to a retirement plan. So this is nice. So if you put into an IRA or a 401k, this is extra money that you can now get as a credit. Well, the beauty is this is a win-win for you because not only do you get the deduction from putting the IRA 401k, now you get this extra money for being single or married, the $1,000 to $2,000 towards taxes as well.
Unbelievable.
It is a nice thing.
I think we're opening some people's eyes. At least I hope so. And this one is going to open your eyes.
Yes.
Gambling losses?
I'm so glad this one didn't apply to me last year personally, but I will tell you, yes. If last year was not a good year for you at the casino, in any capacity, and you have some losses, you can deduct those. Now, here's the catch. You can't lose more than you won. So if you won $4,000 and lost $2,000, you can only deduct that $2,000. We call this zero as your hero. You get down to zero, great, but you can't go negative. You can take all those winnings all the way down to zero, but that's it. But you go, hey, listen, if you had a bad year and you won some, then you lost some, at least you can zero that out and not have to pay Uncle Sam.
Interesting. And these are the 7 out of many that have changed.
You betcha.
I mean, these are similar to previous, but there's a lot of new laws.
Correct. And the updates happen every year, and my job is to keep clients informed and motivated and say, hey, listen, get the best bang for your buck and make sure you're getting all the money back you're supposed to.
All right. Well, great advice this morning. Christopher Dukes, financial analyst, consultant, and apparently does some tax work.
Just a little bit.
Does a little tax work as well. Thanks a lot for coming in.
You're welcome. Thank you so much for having me.
Great job.